Good morning. It's Monday. I'm Vince Lancy, and this is the market rundown. Headline tentatively, miners begin to move as Citi calls for 3,400 gold in 2025. That's right. We kind of held that back because it was just hard to believe, but we're going to touch on that a little bit today. Today, our discussion will involve Citi calling for 3,400, GLD and the short squeeze that's in process, Michael Hartnett implicitly discussing miners and tariffs. We're trying to fit that all into one 20-minute broadcast. We'll just touch on all these things for you. Let's start with the markets themselves. 10-year yields are unchanged bid. The dollar is 108.27, up 17. The S&P 500 is 60.55, up 27.28. The VIX is 16.20. Gold is 29.02, up 42. As high as 29.05. Silver, 32.19, up 42. Copper is 461, up 4. Metals are in part reacting because of tariffs being implemented specifically on base metals. WTI, 72.40, up 90. Natural gas, 363, up 9. Bitcoin, 97 and change, up 900 and change. Palladium, 974, up about 1%. Platinum 982, up 1.1%. Gold, silver still holding the 90 area. It's still a gold-driven rally. Soybeans, corn, and wheat 1046, 482, 594. Unchanged bid for all of them. Wheat's up almost a penny. Homepage. Deep dive. Bullion Bank says we see gold prices rising to well over 3,300 per ounce. That's a quote from Citi. They actually, in another place in the report, said 3,400, but were keeping their lead story more demure, calling for 3,000 in the short term. Flow showed that Hartnett just endorsed miners. He does not talk about miners, but we're going to tell you that he did endorse miners. And the other story there at the bottom, that's an old story that we wanted to reread for our own purposes. China is exploiting inflation now. That's from 2021, written by CEO of a CTO, I should say, of a hedge fund. And he was right. And that was actually right at the beginning of our whole anti-Goldilocks theory. Started as a white stag. Anyway, moving on. Those are the stories. Today's discussion, again, we have several topics. The first one is a report released on the 6th by Citibank called Metal Matters. That's their division. And the story is why gold's bull market is based on physical fundamentals and is set to continue. It is a deep dive report. We're just going to read a couple excerpts and give you an idea of what's going on there, with the hopes that you will read the full report, or the breakdown of the full report, I should say, in our post. Quote, our forecast for investment and industrial demand as a share of mine supply using historical relationship between the share and gold price changes point to 3,400 per ounce in prices by fourth quarter 2025, while we take a more conservative base case. That's the end of the quote. That's the whole context of the quote. There's other context. We're going to get into that. What you're looking at on the page right there, the picture right there, that's the table of contents of the write-up that we did. Now, there's that table of contents again. Setting the table, more upside is coming. As of 2 days ago, speaking about this Citi report, with Citi and UBS raising their targets, every major bullion bank has now raised its short-term target price to 3,000. Two of them, BOA and today, we wrote yesterday, Citi have raised their soft targets even higher to 3,333 and 3,400 respectively. With their latest analysis, Citi joins the 3,000 club. the short-term 3000 club, and describes more specifically the rationale for potentially even higher prices. Team of analysts led by Kenny Yu and Max Layton, both CFAs, I should say, describe not just the reasons for their beliefs, but give a glimpse of the logic and data giving good reason for their beliefs. Simplifying Citi's reasons. And there's a lot of analysis here, but we're going to kind of try and give you a couple things here to make it make sense. Central banks are buying at record levels. Investment demand is absorbing nearly all new supply, and concerns over de-dollarization are keeping gold in focus. The report outlines why these trends are likely to continue, while also highlighting potential risks from trade policy, interest rates, and economic shifts. These words have meanings, very specific meanings if you're in the industry. Central banks are buying at record levels, means they're not buying dips, they're buying strength, meaning they're not waiting for it to dip anymore. Investment demand is absorbing nearly all supply, meaning jewelry, which is sold as scrap, is usually used to replenish supplies. You know, you borrow, you lease gold out, and then you get the scrap back re-refined. Well, investment demand, ETFs, and physical demand from other banks is absorbing nearly all new supply. Means mining supply is not hitting the market. It's not being hedged. It's not going on exchanges. There's no more selling. 3 years ago, we said organic selling is drying up, organic meaning producer selling. And this is the confirmation of it. And concerns over de-dollarization. Yeah, we've all heard that before, right? No, it's bigger because the key word here, and they don't use it, but they use every word but the word, is broadening. It's not just this company or this person or this country worried about de-dollarization. It's spreading. The awareness is growing. Okay, while breaking this report down, Goldfix found four main evidentiary factors embedded in the bank's deep dive. They are: one, mine supply is all spoken for now. I described that a little bit. 95% is already bought. The number matters because the higher the spoken for supply, the higher the correlation between price and demand. There's no new supply available for people to cover their old shorts with, okay? That's key if you're a London bullion player and are counting on new supply so that you can pay Paul back. Remember Rob Peter pay Paul? Second, physical demand is growing and broadening. It's not just the usual buyers anymore. Okay, other countries are buying. Now, there are a couple reasons for that. One of the reasons is in number 4. I'm going to read that one next. Gold tariff calculus is bullish. Now, several banks have done the math on this. Citibank has done it as well. And they said that tariffs are bullish, tariffs are not bullish for gold and silver. And I'll lay those out for you. They've been laid out in the report. But the bottom line is gold tariff calculus is bullish regardless of whether gold is tariffed or not, regardless. And the reason is if you're a country and you say, oh, tariffs are a risk, well, what's the last country that got tariffed? Russia. And then they got sanctioned. And then they got their wealth confiscated. So the threat of tariffs is enough for you to de-dollarize even more, okay? And that is one reason that physical demand is growing and broadening. Serbia has turned buyer recently. Poland is going to have about 20% of its reserves in gold. That's really high, considering that most have under 10%, under 5% in many cases. Okay, number 3, going back to number 3, the return of Western investors. Now, this is entirely their perception. but it's based on their feeling that aside from the geopolitics of it all, that they believe that the U.S. economy is headed for a slowdown. Okay, so they believe that Western investors will continue to return. They've already started due to sensitization of things like inflation and a slowdown, an economic slowdown that will bring more ETF buying. The bank describes in much more detail their rationale than most other banks, and in doing so, show the data to prove their points. We'd have to say this is an excellent report. Excellent in that it raises the bar for every other bullion bank to either catch up or fall behind. This is the kind of analysis that we were raised on the equity side. So we're very happy to see somebody throwing the effort in there. Goldman's report was also very good for a different reason. All right, the report is must read, and our breakdown of it is must read as well. It tells you why this will continue to happen. What's happening today, why it will continue to happen. From a fundamental story broken into factors giving evidence of it. Okay, next, GLD shares get squeezed as free bullion window closes. Now, Bob Coleman and Ronan Manley have noted GLD shares have become ridiculously hard to borrow for shorting. This is a phenomenon we're familiar with historically, but Bob has been tracking this for some time, going back to 2020, and has focused on silver as it being a very nice canary in the coal mine for problems. But now it's happening in gold GLD. Historically, going back to the SLV debacle in 2011, which, by the way, is when we got our education on why this matters. This is believed to indicate, meaning shares being hard to borrow, this is believed to indicate that GLD custodians have now started to protect their bullion from raids, as short sellers will use borrowed shares to extract GLD bullion for other purposes, making GLD essentially a source of bullion leasing. So in English, if you need some bullion for whatever reason, you can short GLD if you're in the crowd, and you short GLD and the shares are destroyed, and those shares being destroyed because you've borrowed them, you now can extract the bullion. Now, I might not be 100% correct on the mechanism of this, but I'm correct enough to know that when enough people start shorting GLD, not because they're bearish, because they need the bullion, well, you're looking at an arbitrage. As lease rates go up somewhere, if GLD borrowing rates don't match the lease rates, well, and I need bullion, well, I'm going to short the GLD. Okay, so what they've done is this has been going on for some time, making GLD and SLV essentially a source of bullion leasing. Now, the problem in 2011 came when the FT was asked and wrote about if there was bullion that was spoken for twice because of this, and their answer, we'll get to that another time, but you can click on the article that's there on that. And the answer is there's risk of it, and there's risk of it. Let's put it that way. This chart that we're going to blow up here for a second indicates, for our purposes, indicates panic in London as a decades-long crowded trade of borrowing and waiting for some miner to hit the bid for them comes to an end. So there's the chart. You're looking at the price of gold in, I don't know, what is that, Burgundy, and GLD short volumes. Now, you may not see a pattern there, obviously, but here's a pattern for you. When the price of gold goes up, GLD borrowing, which is the blue line, should not really matter. It should oscillate. I'm bearish, I'm bullish, I'm bearish, I'm bullish. So that's the short volume, people shorting it, right? So if people are shorting it because they're bearish, you stay in a range. But if people start to short it to get the bullion out, you start to peak out of the range. And when that happens, whoever's the custodian of GLD should kind of get a little bit nervous. And if they own a lot of GLD shares, they can respond by saying, we're not going to lease ours out because we don't want people taking the bullion out and essentially wrecking the market. So if you're looking for a correlation there, well, you want to stay with this area here, right? Okay, so this area here is gold going up. And this area here, although it's extremely volatile, this area here is lease rates creeping up, but still in a range. And then they get to here, want to call that resistance, want to call that this is where people start to get nervous about the bullion itself. And then it spikes to here. Okay. And then it dives. So that's because it spikes to here because someone is raiding the piggy bank for some bullion, my opinion. And the reason it dives because that rating has been prohibited because gold becomes even harder to borrow to short. Okay, so when the blue line dips violently like this, you can go back and do a regression, but it means one of two things. One is very bullish and one is very bearish. The one that's very bullish is if we're not going to let you short the gold in GLD to get the bullion out, then you're going to have to go into the futures and buy your gold. That's the bullish scenario. The bearish scenario is, the bearish scenario is we found the gold. We don't need to short it anymore. Now, the reason for shorting might be why it came off, but we happen to know from talking with Bob Coleman and other people that it's just harder to borrow, and because it's harder to borrow, you just can't short it anymore. Okay, so that's that. All right. Next topic. Michael Hartnett of Bank of America says buy the miners without saying it. He did not say it at all. In his report, which we're going to use, we're not going to be going live tomorrow. We're going to use a portion of this because I think it's very good. Michael Hartnett likes emerging markets, and Michael Hartnett likes international stocks in general, and he loves gold. If that's his calculus, he should also be bullish miners. Now, we said this on Saturday, and here we are, Monday, with gold up $50. We think he already was being bullish and described why. So here's a chart. So far this year, miners have been outdoing tech and emerging market stocks year to date. Now, why am I comparing miners to tech? Well, it's miners versus tech. You know, Hartnett has said when bullion, talking about bullion, when bullion takes the lead in a rally compared to tech stocks, then the whole market and economy is changing. So if bullion's taking the lead, as it still hasn't been, but it has been in the last, say, month or so, what are miners doing? Well, miners are responding. If he also likes emerging markets, that's the blue line, because they're starting to go up. Well, why wouldn't he like miners more? Look at those lines. The miners are the burgundy line, and the blue line is emerging markets. So he's not talking about it, but he's seeing what we're seeing. Okay, so Michael Hartnett has noted in previous reports when, quote, leadership changes between gold and tech, that will be a very bullish sign for gold due to recessionary fears, weaker US dollar, and tech bubble shrinking. We're saying the green light has been given to own miners, and today's behavior tells you that. All right, we'll look at that a little bit more in the charts as well. There's that chart again. Moving on, news and analysis. There's a deep dive. Bullion Bank says we see gold prices rising to well over 3,300. That's 3,400 now. Nothing's changed. We're just trying to be demure about it. Founder special. That's a little bit more detail. Flow showed that Hartnett just endorsed miners. We believe he did. And Standard Charter, our first love as a bullion bank, is all about Bitcoin now. Saying Bitcoin to 500,000 by end of Trump 2.0. We wonder if Standard Charter is not a bullion bank that's getting their ass handed to them, because the bullion banks are now cannibalizing themselves. So much we can talk about. Market news, Trump tariffs and DeepSeek dump. Okay, so Trump tariffs is what you're going to be looking at right now. Why are we rallying? Because of Trump tariffs. And it's true. It's true. And industrial metals are being tariffed. We believe, and others more esteemed than us, we believe that Tariffs will continue, but on a item by item basis. So blanket tariffs can backfire with China. And so he's just going to pick things that we don't need to import. Okay. I'm not being cynical. You pick things you don't need to import. I don't need to import aluminum. I don't need to import copper. And you protect your domestic industry. I don't need to import steel. I need to protect the industry. And that's a good thing, right? And there's risks with that as well. He's not going to tariff, at least I don't think he will. I think it would be crazy bullish if he did. If he were to say we're tariffing silver, that he's basically saying to Mexico, sell your silver to China. And where's the price of silver going to go? The price of silver is going to be high here. We're not going to buy any. We're not going to buy any because of the tariff. It's not a true price. It's a tariff price. The price of silver is going to go up in the world as they buy up to our tariff price. And the price of silver just goes up and we will not have bought any on the way up. So if he tariffs silver, it's going up. If he tariffs gold, which I think would be crazy to do, gold would explode. There's just so much about the psychology of gold that makes it difficult to tariff. I mean, just threatening to tariff gold, as we said at the top, just threatening to tariff gold is bullish for gold because now I'm a small country. It's like, oh, he might tariff gold. I should buy more. He might tariff this. I should buy gold. Every time he says the word tariff, a little country says, I think I'm going to buy another 100 ounces of gold. And that's what happens. So to quote the story, Donald Trump said he would on Monday impose a 25% tariffs on steel and aluminum imports, expanding his trade conflicts to the metals sector in a new burst of protectionism from Washington. That's by the FT. You can see that even when they're saying something that's constructive about the country, they're saying something negative about Trump. That's why gold is in the headlines at Bloomberg, because tariffs and gold going together, the legacy media can demonize Trump by saying he's making the bad metal go up using the bad tariffs. Anyway, DeepSeek is deflating the cost of building AI products, and everyone's spending money on it. Who the hell knows why? Unemployment rate is this week. Big week. Unemployment. Powell testifies for, I'm sorry, not unemployment. I need to change the headline. CPI this week, PPI this week, and Powell testifies before Congress. Premium. Well, this whole post was premium. But if you want to learn more, we would strongly recommend, ask you to subscribe. Thank you very much. So in summary, gold makes new all-time highs on a combination of things. Citibank raises their price target to as high as 3,400 in 2025. Donald Trump, President Trump, initiates tariffs on aluminum and steel with ongoing threats and implications for silver and gold. And the LBMA crisis continues as GLD shares get hard to borrow and short. Have a good day.